Hello everybody, so welcome to this video called These Stocks Are Still Too Cheap. And this is a rapid fire style of video. I'm not going to tell you much about the underlying business of the stocks. I'm just going to show you the valuations and tell you what I think about the price action and the nonsense that many of these stocks have valuation-wise. Also note, of course, on this channel, I cover crypto, I cover Bitcoin derivatives quite a bit. I cover stocks that have special technologies, special advances like Tesla, for example, who may always seem overvalued. These stocks, they seem consistently undervalued, among the most undervalued stocks in my most undervalued stocks spreadsheet. So, and there's a lot of them. I kind of selected them at random. These are the stocks that I'm looking at right now, but there's many more of them that are also cheap like that. There's probably about, 20 stocks that are in the same range of quote-unquote cheapness than these. But these are particularly cheap and particularly compelling in my view. So let's go. Let's get started. First stock, HIMS and HERS, needs no introduction of this channel. On this channel, the future of healthcare. A big tech company could take over healthcare in the United States. That's what HIMS is. It's a data-driven big tech company in the making. Their latest product, they attacked primary care physicians with a labs offering. They've attacked a lot of very, very profitable verticals. If this company is much more than just ED, and the company is dirt cheap right now. It's trading at a 0.11 on enterprise value over gross profit, over revenue growth. So that's much too cheap for a company that is positive EBITDA margin at 13%. So this company makes cash. They actually have a buyback in place. $250 million buyback. The rule of 40 is exceeded by 50%. They have a rule of 60. And this company, despite them losing the partnership with Novo, they don't sell branded GLP-1 anymore. They lost that partnership in Q3. We all expected an awful Q3. The most optimistic of us, of which I was, expected a flat Q3 versus Q2. They actually not only had an up Q3, but they beat their Q1 when they still had a full quarter of a GLP. So this company still has impressive growth, 47% revenue growth. This is a company whose growth actually accelerated. When I was covering this company 2 years ago, it wasn't growing as fast as it is growing now. It's one of the few companies where if you look at the revenue growth line, it has accelerated. Granted, a little bit of a deceleration compared to Q4 and Q1 of last year, but still an acceleration in the speed of revenue growth compared to the numbers of 2023 for this company. So HIMS and HERS, I'm very bullish on the stock at $37. I cannot believe it. I cannot believe the stock is this cheap right now. Rebounded a little bit yesterday, plus 12%. This is nothing like it should rebound. After the Q3, in my view, this stock should have done up 30% after the Q3. But we've had liquidity issues in the market. Another stock that I like a lot, very, very little covered, next to no coverage, it is CorMedix. So it's my... I guess for this segment, it's going to be the only traditional health tech company. So really briefly, this company is a solutions provider of antimicrobial system. They provide antimicrobial drugs, anti-infection products. They have a product that costs about $200 a vial, and it's a hemodialysis product. What you do is you use that product and you prevent infection for people who have to go to dialysis, i.e. at the end of type 2 diabetes. Essentially, the product saves a lot of money for Medicare, which is why I believe that product is somewhat safe. A little bit of recon negotiation, but the main product is somewhat safe. Product is insanely high cash flow, and so as a result of that, they were able to acquire another firm of equal size with a diversified set of products in the antifungal, anti-infection space. That company being called Melinta, and now they are a fully new company called CorMedix. They used to be called Cormedics Therapeutics. Anyways, doesn't really matter. It's a company that there's a lot of very innovative companies in the healthcare sector. The healthcare sector, and I don't want to call it biotech. Sometimes people call like health tech companies biotech. I don't want to call it that because it has a stigma attached to it. But there's a lot of very innovative companies in that space. Very few, next to none, have an enterprise value over gross profit, over revenue growth of a 0.029. And you can go on my spreadsheet. I have like 30 plus of them. None of them are this cheap. Look at the numbers. Enterprise value over forward revenue growth, 1.5x. Forward gross profit, 1.59x. Gross margin is insane, 96%. Enterprise value over adjusted EBITDA 8 times. This company is way too cheap. This company had a good quarter. The stock dumped, just like every stock that has had good news over the past month and a half has dumped. Cormedix is no exception to the rule. Good quarter, good news, they dump. HIMS, good quarter, good news, they dump. It has been the nature of the market. Moving on to another stock, which had amazing quarter and amazing news. The first news, of course, for Nebius was the 15, was it 18? I think it was 18, and then you had an extra 1.6 billion. So let's call it 18. $18 billion contract with Microsoft. And then during the Q3, they also announced another $3 billion-ish contract with Meta. So this stock, and this is not a typo, this stock is predicted to grow revenue next 12 months at 1,600%. So their revenue is gonna do. And you can assume a margin of error. It's gonna do anywhere between a 10 and a 20x over the next 12 months. And their guidance, by the way, fits squarely with that number, between a 10 and a 20x. And so one has to ask themselves the question, what is going on? Why is this company so cheap? I don't know. The market seems to be thinking that I really have no idea. The initial reaction when the stock shot up to 135 after the deal with Microsoft announcement, in my view, that was the correct reaction. And it's just dumped and sold off like every other company in the AI sector. It got identified as this poor AI play. Nibbius is a differentiated company because they have a software stack a la AWS. Just like AWS has its own stack, Nibbius has a GPU software stack. They go beyond just the bare metals. They also provide software. That's what makes their data center more special than, say, a classic bare bones miner. What also makes them more special is that the management team used to be part of big tech. The management team at Nibbius used to be founders and leaders of Yandex being the Google of Russia. When the conflict with Ukraine rose, they left Russia and they took some of their assets, and one of the companies that they founded, the company they founded was Nebius, okay? And it came with venture capital money. It came with, for example, a 28% stake in ClickHouse. It came with an AV division called AV Ride, Autonomous Vehicle Division. It came with a lot. So this company also could have some big tech vibes, in my view, just like HIMS could have. And if there is going to be a new type of hyperscaler, which is a GPU-based hyperscaler, I see Nebius as a potential candidate to become that GPU-based hyperscaler because of their AI software stack, which a lot of the other players don't have. And this stock is trading at an enterprise value over gross profit, over revenue growth of a 0.04. This is among the cheapest I've ever seen in my spreadsheet. Keep in mind, in my spreadsheet, most stocks are like 0.6, 0.8. Many of them, especially value stocks, are like in the 1 and in the 2s on EV over GP over RG. This one is 0.04. So in the way I value a stock, I look at Nebius at something like 30 times cheaper than the market. This is how crazy that is. Okay, let's move on to another another stock, OSCR. OSCR needs no introduction. OSCR I've referred to before on this channel as kind of a swing trade for me, even though I don't trade, but like kind of like a 3 to 5 year old, not longer. And my usual olds are ideally more than 10 years. OSCR, kind of medium, because I don't want to be into the insurance business. I consider the insurance business to be just riskier. The law can change. Medical loss ratios need to be met. And it's too politically driven. It's too politically driven of an industry. That being said, this is kind of the same situation as CorMedix. I don't necessarily want to be in the anti-infection medication business, but when I see a value like 0.02, my eyes go crazy. I'm like, this is so cheap. So this is a similar situation for OSCR. It's like, I don't necessarily want to be in that business. Unlike HIMS or Nebius, where I want to be in those businesses a lot, but I don't necessarily want to be in the marketplace, Affordable Care Act policy business. But when I look at the valuation, I tell myself this is absolutely crazy. Enterprise value over gross profit over revenue growth is a 0.024 for a company that has said multiple times before that they do not need the ACA extended. They do not need the ACA extended to achieve their growth targets. Well, guess what? They're probably going to get it anyways. And when they get it, a lot of people are expecting this stock to bounce back to the 30s, right? A lot of people are expecting that if we actually get ACA renewed for like 2 years, the stock is going to be $30. And that's what a lot of people are making this bet for. Now, of course, keep in mind, a lot of the stocks over the past 45 days have had amazing news and they dumped 30%. So if this market continues to be crazy, if we continue to have crazy liquidity issues in the market, you could have amazing news and the stock still drops because of the liquidity. But nonetheless, the stock got way too cheap. It traded in the $13. I can't believe it traded this low. To me, this stock is an opportunity even at 16. It is still too cheap. Moving on to another stock where I am the only one who talks about this stock. A small cap, or dare I say a gem, is how I could call REAX, the real brokerage. The real brokerage, actually, I've seen in my neighborhood, in my Texas neighborhood where everybody's trying to sell a home. I've seen signs for the real brokerage. So what does that tell you? The real brokerage actually has been able to grow very fast at a 50% clip, during the most awful real estate market transaction-wise. They've been able to grow in an awful market. I think if the market continues to be awful, which it inevitably will stay awful until May 2026 and until we get a new Fed chair, it's going to stay awful until we get a new Fed chair. In May 2026, we get a Fed chair that probably like, we need to expand our mortgage-backed securities on the balance sheet. That's probably what we get in May 2026 because we're going to have Mr. Dove. Like, I want to position myself before we know that Mr. Dove is coming and that Mr. Dove is going to, do something about the real estate because they need to do something about the real estate. Its construction is in a crisis like no other. There's a lot of realtors who are absolutely struggling right now, and realtors, you tend to have a certain group who becomes realtor. And anyways, I don't want to get into the weeds here of my explanation. My point is, I much prefer it to open door. I think this fits so neatly into my spreadsheet. This is enterprise value over gross profit over earning over 0.09. Rule of 40 is 53. The way REAX grows is that they have created commission incentives that will attract the top 20% of realtors. The top 20% of realtors want to move to REAX. Those who don't need guidance, who don't need handholding, and who can hit very high performance targets so that they can get a fee-free service or a commission-free service after they hit, I think it's 15 transactions or something like that, they will be attracted to REAX. The average real estate agent or the low-performing or occasional real estate agent will not be attracted to REAX. That's how they kind of built the brokerage, and that's how they've been able to grow at 50% a year for the past many years. And I swear, if you look at the revenue growth of REAX and if you look at their numbers, you would not believe there is a real estate crisis right now. Their numbers look as good, their growth numbers look as good as, say, HIMS or SoFi. They look as good as that, and it's totally under the radar. So I like REAX very much. And the last stock that I will discuss on the channel is Zeta. Zeta is an AI native marketing company which could, and I say could, be a threat to companies like Salesforce. I've been reading more and more about Zeta and studying a little more. They have a top-down approach to sales, for example, a bit like a Palantir. Palantir versus Snowflake. Snowflake was trading bottom-up. Palantir was selling top-down. Zeta sells top-down. So, a lot of people on X are not going to be using Zeta. It's big companies who use Zeta. But anyways, the point I'm trying to say about Zeta is they're AI native. They have a modern software stack, and they are a marketing company that helps you connect all of your functions of marketing into one software. And that software also has a chatbot, and it's a non-technical software that anybody can use to run their marketing campaigns, to have very strong marketing campaigns or like TV, etc. Interesting play, entirely different from, say, the Trade Desk or CRM, right? Salesforce, but also grows very high. Forward revenue growth almost 30%, which is my minimum threshold. Rule of 40 is 49. And I could see this coming. You may say, wait a minute. EV over GP over RG is 0.19. That's expensive, right? That's expensive. Well, first of all, no, it's not that expensive. Compared to the average stock in my spreadsheet, this is still dirt cheap. Anything under 0.3 in general is dirt cheap. What I think is remarkable about Zeta is the sector. The sector that they are in, SaaS IT software, usually gets an EV over GP over RG of like a 0.8. So compared to the peer group, compared to their peer group, I would say this company is like 4 times cheaper than their peer group, and they have a product which is clearly resonating with their Fortune 1000 customers. So, and they have a, so it's a SaaS, right? So you get into the other metrics like the dollar-based net retention ratio. I think it's like 119% or 120%. So not quite like Snowflake's in the early day, but kind of high, kind of close to it. So I understand like some people note the similarities between like a Palantir and a Snowflake. I note these similarities too. I think this stock is very interesting at this level, knowing that, it's sold off because it's a great stock. It's a great growth stock, and great growth stocks have sold off due to liquidity that we've had over the past 3 weeks. So anyways, I selected 6 stocks. I guess next time I'll select another 6. I told you there's about a good 30 stocks that I find very, very cheap right now. These are 6 that I like right now. So anyways, and of course, they're not Bitcoin related. I figure I would let my viewers breathe and not talk about Bitcoin for like a day or something. Anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.